All right, let's get right into it. You look at the major stock indexes, and what do you see? All-time highs. It looks great on the surface. But just underneath all that, there's this really powerful sense of anxiety, a feeling of weakness.
So, what's going on? Why are stocks hitting these incredible records while at the same time it feels like they're teetering on a knife's edge? Well, that's the central puzzle of the market today. And in this explainer, we're going to unpack this huge tug of war between two really powerful opposing forces that are pretty much defining everything right now.
So you've got these two things clashing. On one side, you've got this incredible, unstoppable momentum of the AI boom. It's like a massive technological tailwind just pushing parts of the market up, up, up. But then on the other side, you've got this big geopolitical headwind. I mean, a real wall of worry that's been built up from trade disputes and economic risks. And that is hitting the brakes hard.
Okay, so first up, let's take a closer look at that engine, the thing that's pushing everything upwards. And here's what's so important to get. This is not some broad, everyone is winning kind of rally. Not at all. It's incredibly focused. And this quote, this one really just says it all, doesn't it? It perfectly captures the mood of the market. All the energy, all the money, all the hope, it's all chasing one single story: artificial intelligence.
And look, this isn't just hype or some abstract idea. We're actually seeing it in the hard numbers. You've got tech titans like Alphabet posting these super strong results. And that just validates the whole story, right? They're pouring more and more money into AI infrastructure, which then, of course, lifts up their peers like Microsoft and NVIDIA. It's creating this powerful ripple effect all across the global supply chain, especially hitting places like Taiwan, which is basically working around the clock to keep up with all this demand.
And if you want to understand the sheer scale of that demand, just look at this number: 140%. That is the staggering year-over-year jump in Taiwan's exports of AI-related gear to the U.S. I mean, that's not just a nice little increase, that is an absolute explosion. But you know how it goes. For every action, there's an equal and opposite reaction. So now, let's switch gears and look at the other side of this thing, the powerful forces that are slamming on the brakes and creating that big wall of worry. And the thing is, it's not just one single problem we're talking about here. It's more like a chain reaction. It all starts with punishing trade policies, which then forces the hand of the Federal Reserve. And all of that ripples out and starts messing with the real economic data we see.
So let's start with the most immediate risk on the table: trade policy. For a while, tariffs were just this kind of threat, something off in the distance. But that's over. Now we're seeing the real, tangible costs hitting corporate balance sheets. And here's a perfect example: a loss of $1.1 billion. That's the profit hit that General Motors reported, and they pointed the finger directly at tariffs. This is exactly what it looks like when an abstract political threat becomes a very real and very large corporate loss.
Okay, now this is a really big deal. The U.S. Federal Reserve is now explicitly saying that their future decisions on interest rates are tied to inflation caused by tariffs. This adds a whole new, profound layer of uncertainty, because now the Fed's policy, which, affects the entire economy, depends on these totally unpredictable political negotiations. It makes trying to figure out what's next incredibly difficult.
And to top it all off, even the good news might not be what it seems. So the U.S. recently posted this headline GDP growth number of 3%. Sounds great, right? Fantastic even. But you just have to peel back one single layer and you find it's a bit of a statistical illusion. The core measure of what's actually happening, what people and businesses are really buying, slowed way down to just 1.1%. That's its weakest level in years. So the big flashy headline is actually hiding a pretty clear slowdown underneath. So with this huge tug-of-war going on, how does it all actually play out in the market? Well, it creates this complete and total divide. Your experience as an investor really depends entirely on where you happen to be looking, because we're basically seeing two different economies running at the same time.
And here in the US, that split is crystal clear. You've got the tech-heavy indexes like the NASDAQ and the S&P 500, which are just packed with those AI giants. They're soaring to record highs. But then you look at the indexes that represent the broader, more traditional economy. Think the Dow Jones, small cap stocks,
and they're lagging behind. Some are even declining.
But this is where it gets really fascinating. This whole conflict is playing out in miniature, like a microcosm, inside the very heart of the AI hardware supply chain. You'd think everyone in Taiwan's tech sector would be absolutely booming, right? But that's just not what's happening. Just look at this. Right here, among the top 5 Taiwanese tech companies, you see this dramatic split. Delta Electronics, a key supplier, strongly positive. But at the exact same time, you've got giants like Quanta Computer and MediaTek that are in a deep negative trend. And even a bellwether company like TSMC is just neutral. What this tells us is that investors are becoming extremely selective. They're rewarding a handful of very specific winners and punishing everybody else. So why does all this matter so much? Because it's a story of what you could call industrial codependence. The economies of the US and Taiwan are woven together way more deeply than most people think. It's not just that one buys stuff from the other. It's a codependence based on building things together. Take a look at this. Over 62% of what the US imports from Taiwan is machinery and electronics. And let's be clear, we're not talking about finished consumer goods like t-shirts or toys. We're talking about the essential, high-tech components, the literal building blocks for America's own industries.
And this number, over 90%, this is arguably one of the most important statistics in the entire global economy today. That's the percentage of the world's most advanced semiconductor chips that are produced by Taiwan. The entire modern US tech economy, I'm talking from our phones to our data centers to the AI revolution itself, is profoundly, deeply reliant on this one single source. Any disruption here would have absolutely massive consequences. Okay, so this all brings us to the final conclusion, the main takeaway. When you put all of these pieces together, you start to realize the market isn't just going up or down. It's performing this incredibly precarious balancing act. It's walking a tightrope. It's being pulled in 2 completely opposite directions at the same time. On the one hand, you've got this powerful, durable growth story in AI that's fueled by real earnings and investment. But it's running head-on into these significant and frankly growing global risks from trade policy and a slowing economy. And that leaves us with the billion-dollar question, the one that defines everything for today's market. Can the AI engine, with all its power, actually outrun this geopolitical storm? The answer to that is going to determine the path forward, and for right now, it leaves all of us, investors and observers alike, walking a very thin tightrope into the future.